Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you're keeping very, very well. It's Friday, it's very early in the morning, hence the reason the office behind me is absolutely empty. But yeah, and the sun is shining, so hopefully you're in for a weekend of good weather. I think we can all do with some positivity at the moment. Now, in terms of what we've got for you today, we've got some really good content. We have got an update on some lender pricing movements, some new rates that have come to market, which are actually quite interesting. I'm going to give you a broad overview about actually what is the kind of current state of play with regard to mortgage rates more broadly. Then we're going to have a look at an opportunity that lots of landlords are eyeballing in terms of future investments and share those with you. And then lastly, we're just going to talk a bit about what's going on in the housing market. So first of all, yesterday the MPC increased bank base rate by 25 basis points, and what we have seen in anticipation of that rather than in reaction to that is a further wave of pricing increases from various lenders in the market. So what have we seen? So we've seen Accord Mortgages increase their rates by up to 20 basis points. TSB have removed some of their products. They haven't really re-released them yet. These are their products which have the flat 995 arrangement fee. They are expecting those to come back to the market. I think they were just at the point of putting those rates, firming up their pricing model on those. Capital Home Loans have made some rate withdrawals and some rate increases. Keystone have increased their rates by up to 20 basis points across the range. The Nottingham Building Society have made increases of up to 14 basis points, and BM Solutions have made rate increases of up to 24 basis points as well. And we've also seen the Leeds Building Society withdraw some of their products and not re-release them. So another very busy week of pricing adjustments upwards, unfortunately. Now, in terms of where this leaves us, I just wanted to kind of give you a state of the nation in terms of pricing. So look, as much as when you're listening to all these rate increases, it can sound like things are desperately bad, and actually mortgage rates are very, very expensive. Actually, the pricing is still not bad at all in the round. So look, 2-year pricing, personal borrowing, standard properties starts from 1.09. 5-year fixed rate pricing, standard properties, personal borrowing from 1.74, 10-year fixes, and we are seeing a lot more people asking about 10-year fixes at the moment, now from 2.45%. I mean, look, if you can fix for 10 years at 2.45%, that can only be a good thing. I mean, I remember when a fixed rate for anything over 5 years and anything less than 5% was really good. So looking in for 10 years at 2.45 is actually still incredibly competitive. Limited company pricing, 2-year fixed rates are now from 2.44, 5 years from 2.65, and 10 years from 3.19. So like I say, as much as when we're talking about the lenders putting their interest rates up, of course, yes, it is pushing the cost of mortgage pricing up, but you will see that still there are some very, very good pricing, some very good deals to be had. Now, conversely to the rate increases, we've also seen some lenders make some reductions on their products, and this will be largely due to the fact that they're just willing to reduce the amount of profit that they make for every pound of money they lend out on mortgage rates, essentially, to drive up new business. So first of all, Foundation Home Loans have released a tranche of green mortgage products. They've released 6 new HMO products, 6 new short-term lets, some 5-year fixed rates, and these are all for their green offering. So green properties, just to recap, are properties with an EPC rating of between A and a C. Anything over a C fall outside of being classed as green, and this is not just for Foundation Home Loans, this is for all lenders in the market currently. So look, where does this leave them? So they now have rates on their green range starting from 3.34% on their standard offerings. This is for standard properties available to individuals and limited companies. Now, for Foundation Home Loans, their offering in the limited company space is actually very strong. One of the things that I really like about them is they only take personal guarantees from the directors. They're not underwriting the shareholders. So what this means is that if you have a company structure which is falling outside of policy with the more vanilla lenders, so for example the mortgage works, these guys could be a good home for you. So what I mean by that is, if, for example, we had a limited company which was owned by mum and dad were 25% shareholders each, but they also had 2 children that were also 25% shareholders, that wouldn't work for a lot of lenders. Likewise, because they're looking at directors rather than the shareholders, they can accept layered company structures as well. So they've got some really sort of niche bit of criteria there. The other lender who is only looking at directors when they're underwriting their limited company mortgages is Kent Reliance, so fairly niche-y. Now, more broadly, Foundation Home Loans don't mind how much you earn. They don't mind how many properties you've got in the background as well. So very, very landlord friendly. And their HMO pricing on the green range is now starting from 3.49%. For Foundation Home Loans, on their HMOs, the property can have no more than 8 letting rooms. Now, we've also seen Shawbrook make some reductions on their semi-commercial rates. So I think it's fair to say that at the moment, semi-commercial properties are of a lot of interest to quite a few investors, largely due to the potential ability to convert the commercial parts at some point in the future into residential under permitted development. So we are seeing definitely an uptick of interest in these kinds of properties. I think also there's a lot of people that are kind of speculating that going forwards, these properties will be sort of good investments owing to the kind of emptying out of the high street and the adjustment also of live, home, working. Lots of businesses are kind of scaling back on the amount of office space they have as well. So it's really interesting that Shawbrook have kind of taken the opportunity to reduce their pricing here to make themselves more competitive. Now, in terms of semi-commercial lending, I think that, of course, there are lenders in the high street sort of offering, so your Lloyds, Barclays, NatWest, those kinds of guys who are able to lend in this space, but we find that the appetite at the moment is very, very low. So what we're seeing is that when clients are coming to us with semi-commercial investment opportunities, we're tending to approach the challenger banks just because these guys are able to offer 75% loan to value, interest only. Also, their rental interest calculation is much more favourable than the clearing banks, which means people can often borrow more as well. Now, in terms of the lenders who are operating in this space, so we really feel that at the moment the key players are Shawbrook, Interbay, Hampshire Trust and Alica. These seem to be the kind of main players. Pricing on a semi-commercial product will start from around 4.5%, just to kind of manage your expectations. But like I say, people are really kind of recognising the potential future opportunity in investing in these. Also, the stamp duty when you acquire a semi-commercial property is different as well. So we're seeing an uptick in landlords looking at these. So it's great to see that Shawbrook have brought their pricing down in this space. And lastly, from our lenders this week, we have seen West One introduce a 7-year fixed rate. And the reason this is interesting is it's fixed for 7 years, but it only ties you in for 5 years, which is quite niche. I think there's quite a few lenders that have kind of done this in the past. What clients tend to say is that actually they would like to lock in for as long as possible, owing to the obvious uncertainty that everyone's facing at the moment. But actually locking in for 7 years just feels like a really long time. So bringing in a product which has the benefit of the security of 7-year fixed rate, but the 5-year lock-in is actually quite appealing. And pricing here from West One starts from 3.44%. Now, West One are a specialist lender. So again, we're looking at limited companies, individual borrowing where there is unlimited number of properties in the background, no minimum income requirement, all those things that we come to expect from our specialist lenders. Now, in terms of where their pricing sits, so 7-year fixed rates in the market start from 3.02%. Now, that would be personal borrowing, low loan to value. So 3.44, while it is obviously higher, actually isn't a million miles away from that, bearing in mind the kind of broader criteria that they have. So really good to see West One kind of thinking slightly outside of the box, bringing in a product that would probably be a good sort of problem solver for some landlords. Now, Landbay published a really interesting article recently, which I read with interest, which is around opportunities for investors on properties with lower EPC ratings. So what they're saying is that 68% of landlords currently have properties with an EPC rating of D or lower. However, the majority of those, so 80%, intend to make changes to bring them up to a C rating or above. Recognising, I guess, that buying properties and making them more energy efficient will raise the value of the property, and the rental income that they can charge would also increase, plus the tenants will obviously benefit from lower bills. Now, what they said is that additionally, some landlords are viewing these changes as an opportunity, and this is particularly those with larger portfolios of 10 or more properties. So 53% of these landlords said they would consider buying homes that are D rating or lower and bringing them up to at least a C. And this compares to 32% of landlords with 4 or 10 to 10 properties who would do the same. But only 20% of non-portfolio landlords would choose to buy an upgrade. So what this really shows is that landlords with larger portfolios are recognising that going forward there's going to be an opportunity to secure those lower EPC rating properties, bring them up to par, and then benefit from the higher rental income that you can see, and obviously an uplift in value as well. And that is everything for me this week. As you'll see, the office is starting to come to life, so time for me to go and grab a coffee, I think. It's still very early in the morning. Thank you as always for joining us. If you do have any questions, we'd love to hear from you. 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. I will catch you next time. Until then, please do look after yourselves.